Hi everyone, welcome to the weekend session of ABM Warrior series. All the questions. In weekend session, we'll be covering, as a daily basis, we cover case studies and MCQs. We cover it for all, means objective questions, PYQs, all of them are covered for ABM and all the subjects. I cover it for ABM and BFM and others cover it for other subjects as well. So follow the series completely, like the channel, subscribe to the channel, click on the bell icon. Don't miss this, okay? Because all these questions, the case studies are previously asked somewhere. Today also you'll see, I'll ask the case study, first case study which I'll take is a previously asked case study regarding the portfolio of loans. Very important one, follow it till the end and kindly note, don't miss even the last part of this because last questions are also very important. Okay, so don't miss this and let's move on. First one. A bank has a loan portfolio to a company A. A bank has a loan portfolio to a company A of rupees 100 lakhs. So loan given to a company is 100 lakhs by some bank. Probability of default for the company A is estimated at 2%. And the loss given default is 40%. Means if I am having the loss, then if the company becomes NPA, then the loss for me as a bank is 40%. So now question, calculate the expected loss for this loan. How will you get the expected loss? If this question comes, this question might come for 1 mark or some additional question joint 2 marks. How to find the expected loss? Does anyone have the formula? Expected loss? Expected loss equals to, I'll write EL only, okay? EL equals to loan amount, loan, into probability of default. So simple, into LGD. So simple. Loan multiplied by probability of default multiplied by LGD. So that is equal to what? What is loan now? Loan is 100 lakhs. 100 lakhs into probability of default is what? 2%. 2% into what is this? 40%. So calculate it. Calculate it. Kindly don't do it manually, okay? Try it with a calci. Always try it with a calci. Why am I telling you? Why am I telling you? Because don't try it orally. 40 to the 80. Don't do this 80%. Because you will go wrong in this. Whenever you are calculating percent, kindly note this. Whenever you are calculating percent, 100 lakhs into 2 upon 100 into 40 upon 100. See, upon 100 creates a lot of difference. So calculate it now. So 100 gone, 4 to the 8, 80 upon 100. So 80 upon 100, right? This is right now. 80 upon 100. So it is equal to 0.8 lakhs. This is in lakhs now. So it will be in lakhs. So 0.8 lakhs. Kindly don't miss out on the calculations. So what is the expected loss then? 0.8 lakhs. Okay. While doing the calculations, even I myself have done the mistakes over here in doing these calculations. Upon 100 we forget to 10 because we are dealing in percentage. Whenever we deal in percentage, we have to focus on upon 100. Okay. Next. Which of the following is not a primary type of financial risk faced by the banks? Not. Market risk, credit risk, liquidity risk, strategy risk. Financial risk. It should not be the financial risk. What is market risk? Market risk means any risk which is not in your hands. USA attacking somebody, Russia attacking somebody, China attacking somebody, and the oil prices rise. Not in your hands, but your financial loss will be there. Financial risk will be there. So this is the part. So I'll just write not a primary type. So I'll write it primary type. Credit risk means I give the loan to somebody and that person never pays back. Never pays back. Default. So that is again the primary type. Liquidity. Liquidity risk means, see, liquidity risk just now we did, I think so in BFM also. Yeah, in BFM we did it earlier. So liquidity risk is mainly of three types. Kindly note. One is time risk, time. Okay, time risk. Second is call risk, call risk. And third one is funding risk, funding. Remember, although this is not the answer, but you have to remember the concepts. I am not here to just give you the answers and move on. The answer is simple, strategic risk. Answer is strategic risk. What is strategic risk? Strategic risk means your inability to focus on the long term. Inability to focus on the long term means what? There are many examples. You remember the phone Nokia phone? How many of you remembered Nokia phone? Everyone was having Nokia once in 2006 to 8. Every hand was having Nokia. Where is Nokia today? Do you have a Nokia phone? How many of you have Nokia phone? Just type. Yes. Everyone shifted to Android very fast. So strategic risk. Nokia should have thought of it. Okay. Number one. Some companies are there. Kodak company. You remember the Kodak mobile, not mobile, cameras? Kodak, Konica, Yashica. There were so cameras. Where are they now? Gone, isn't it? Theaters. Single run theaters means single screen theaters. Where are they now? Single screen theaters. Gone. Strategic risk. Long term thinking not there. Where the world is changing, you are not changing. If you don't change, you are gone. So that is not a part of your financial risk. This is a long term business risk. This is called as business risk. Okay? A bank faces the possibility of losses arising from the increase in the repo rates by RBI. Increase in the repo rates by RBI. RBI increases the repo rates, and because of this, bank might face the losses in, let's say, its bond portfolio. Because where will bank face the loss if the repo rates increase? Bank will face the loss in mainly bond portfolio. Okay? Of course, in loans also they will face, deposits also, but both will increase simultaneously. If repo rates increase, your deposit rate will also increase, your loan rate will also increase. So both will match each other. But the problem is in the bond rates. Bond rates go in the reverse direction. If my repo goes up, my bond price will go down. It is always in the reverse direction. Okay? So, this is an example of what? Market risk, operational risk, credit risk, reputational risk. It is an example of market risk. Market, because it's not in your hands. RBI should increase the repo rate or not. Is your bank concerned in that? Does RBI ask your bank, should I increase the repo rate? It will not ask. So, whatever is not in your hands, but it affects you, is basically known as market risk, right? So, the answer is market risk. Okay, bank faces the possibility of losses arising from the increase in the repo rates. Let it be increase or decrease. Both the sides you can have the losses. Okay. Which among the following is not a micro level step taken in mitigation of credit risk? So, which among the following is not a micro level step taken in mitigation of credit risk. Not. Pay attention to the question. Not. Okay? Don't get confused. In exam, I'll tell you, many of the students lose almost 6 to 7 marks only by not reading the questions. Read the question properly. Not is asked. Not a micro level step. Improving sanctioning and delivering process. Obtention of collateral security. Monitoring and review of individual proposals, categories of proposals. Periodical review of exposure limits for business or industry. Which of them is not a micro level step? Micro. What is micro? Kindly note, in banking there are two levels. Again, two levels. I'll give the clear bifurcation. Micro and macro. Macro. Okay? Micro and macro. Micro means what? Micro means branch level. Branch. I'm very clear in this. Branch. Macro means HO. Head office level. At branch level, what do you do to mitigate the risk? Mitigate means reduce. What do you mean by mitigation? See, there are 2-3 words. Okay? One is, where is it? Mitigation. So, mitigation equals to reduce. Reduction equals to hedge. Hedging. Okay? All are one and the same. Either hedging the risk, mitigation of risk, reducing the risk, one and the same. So, at branch level, what do you do for reducing the risk? At branch level, what do we do is, number one, we'll take a collateral. See, I won't write it now. We'll take a collateral. We'll do proper analysis of the loans. We'll do the management analysis. We'll check the persons behind the company. Okay? And legal documentation. All these 3 parts we'll be doing. And regarding macro level, it's at HO level. At HO level, what do? We do 2 things. One is diversification, very important. Diversification. You should not give the loans to a single sector. Okay, you should not give a loan to a single sector. Number 1. Number 2. What next? Derivatives. Okay, derivatives are an important part. Covering the risk. So, look at this. Review of exposure limits for the business. So, this is a part of what? This is a part of HO. Will this be done at HO level or will this be done at a branch level? The overall banking portfolio. Will a branch do this? No. So, it is a part of this. So, you want not. This is a part of macro, not micro. Got it? Clear? A bond has a Macaulay duration of 3 years. The current yield to maturity is 6%. We want to estimate the percentage change in the portfolio's value if the yield increases by 50 basis points. Original value of the portfolio is 120 CR. Find a new value. So there are 2-3 questions involved over here. Very important one and very, I would say, lengthy one also. Not that lengthy because Macaulay duration is already given. See, there are 2 durations. One is Macaulay, second is modified. Okay, Macaulay and modified. What is Macaulay duration? Macaulay duration means the duration in which, within the life of that bond, in which the interest rate risk on that bond becomes 0. Interest rate risk on the bond becomes 0. Macaulay. Modified duration means, see, I have taken this many times, that's why I am not writing. Okay. Modified, Macaulay, interest rate risk, interest rate risk equals to 0. Simple meaning. Okay. During that tenure. Modified means, modified is for 1% change in repo. In repo or any benchmark, in repo, percentage change in price of the bond. This is known as modified duration. Price of the bond or the portfolio, whatever it is. So in this case now, Macaulay is already given to you. First, you have to find out the modified duration. What is the formula for modified duration? Everyone? Modified duration equals to mod equals to Macaulay, Mac upon 1 plus R. Mac upon 1 plus R. Okay, Mac upon 1 plus R. What is Macaulay given? 3 years. 1 plus R. R is what? 6%. So it's equal to 3 upon 1 plus 0.06, 6%. Okay. So it is 3 upon 1.06. That is equal to, find this everyone. Find the answer. 3 upon 1.06 is, and this will be in percentage. Everyone do it using the calci. Yes, it is in percentage. Three upon 1.06, right? So 2.83, correct? So it is 2.83. Got it, everyone? 2.83. But this is in percentage. Percentage. What does it mean? It means that if my repo rises by 1%, the price of my portfolio or bond will fall by 2.83%. Will fall. In earlier numerical, I think so I shown you. So repo goes up, price of the bond will come down. Okay. So now what is given? What is given? We want to estimate the percentage change in the portfolio's value if the yield rises by 0.5 basis points. So now understand this. If repo rises by 1%, repo rises by 1%, my price will fall down by, 2.83%, right? 2.83? Yeah, 2.83%. So if my repo now rises by only, let's say 0.5, so this rises by 0.5. So again, this will also change, right? So 0.5 into 2.83 upon 1. 0.5 into 2.83 upon 1. Do it, everyone. 0.5 into 2.83 upon 1. 2.83 into 0.5. What are you getting? 1.41? Are you getting 1.41, everyone? Are you getting 1.41? So this will change to, price will change, fall down by 1.41%. So first question which is asked is this only. If my yield changes by 0.5 basis points or 50 basis points, 0.5%, then percentage change in the portfolio will be 1.41%. But you are having one more question in this. See, there are two questions involved in this. One is this, and second is find a new value. So now what is the new value? See, now this calculation is very simple. I'll show it over here. Okay. What was the earlier value? 120. Let's forget this crore now. Now this 120 will fall down by 1.41%. So that into 1.41%. Find this. Find the answer. 120 into 1.41%. Everyone. Okay. Remember, don't forget this percent. 120 upon 100. Upon 100, you should never forget. So 1.698. So roughly you can take it 1.70. Isn't it? What are you getting? 1.70. So it will fall 1.70. This is what? Crores. Because this was in crores. So this is in crores. 1.70 crores. Got it, everyone? So the value of my portfolio will fall down by 1.70. But what am I asked? Find the new value. So I have to get a new value. So new value will be 120 minus 1.70. Okay, so that is equal to 120 minus 1.70. So 119, 118.3. Yeah, 118 0.30 CR. This is the value of your new portfolio. So these are the two answers. These are the two answers, everyone. Got it? These are the two answers. Clear? Got it? So, now before going, everyone, kindly join the new batches of Adda 24/7. Just now they are in the starting phase. Huge discount offers are available. I'll show you. See, go to Adda 24/7. Always download the app first and then purchase the batches, because in the app you will be getting 1% extra. Okay, extra discount. Don't miss that 1% also. Okay. See this. Go down. Firstly, I would suggest you to join this ACE batch. Newly, just now it is starting. Ebooks, mock test, online live classes, recorded sessions. Recorded also available. So if you miss out someday, you can have this. You have the doubt sessions. You can ask the doubts anytime. Mock tests are chapter wise also and full length also, like the paper. Ebooks are chapter wise. Okay. So it's a huge thing for you. Click on buy now. Remember the code Y432. Y432. Click on enter. Look at this. 80% discount you are getting. 80%. Plus 1% through the app. So 81%. Good. Very good offer for the single batch. Plus if you want, you can join the Mahapack. Increment Mahapack. Okay. You can join the, like you have JAIIB Increment Mahapack. Similarly, you can join the CIB Increment Mahapack. Right now you are having triple validity offer. Triple validity means you buy for 5 months, you get it for 15 months. You buy for 9 months, you get it for 27 months. Plus 81% discount is there. Now in Increment Mahapack, what do you get? You get physical batches, physical books. Okay. Then ebooks also, question banks. Plus you get formula bank, physical, plus online also, ebooks. Plus you get study planner. Plus you get, means online also. Everything is physical as well as online. You will get again, ebooks are there, mock tests are there, same as the earlier one which I told you. But here the advantage is triple validity and 81% discount. Such offers never come regularly. Okay, join us up. Okay, bye everyone.